thanks to the Corporate Governance Institute of Trinidad and Tobago for inviting me to speak on this, I think, very relevant and timely topic. Now, organizations like the Corporate Governance Institute have been at the forefront of encouraging our companies here in Trinidad and Tobago and across the world to really adopt good corporate governance practices. And in relation to financial reporting in particular, you have recommendations which would include things like, make sure that your finance department is properly staffed with appropriately skilled and knowledgeable employees. Make sure that the head of the department perhaps is a qualified accountant. Also, when it comes to financial reporting, things like, making sure that the management accounts are produced on time, in a timely manner, and the information prepared for the board is relevant and detailed enough for them to understand exactly what is going on, as well as you have discussions around supplementary financial reporting information that should be submitted to the board. And all of these things, I'm sure my fellow panelists and other persons would be encouraging us to make sure these things are in place. For many organizations, you will see tick, do you have a qualified accountant on your board? And everybody is happy for that. Do you have a qualified accountant as the chairman of your board? Tick, everybody is happy for that. But what I thought, as I looked at the topic, what I realized is, checking the box and saying that we have these persons on our team really would require something more. The oversight of financial reporting within an organization is much deeper than, just saying that we have persons who are qualified. And I want to put it to us this afternoon that this oversight is a very active word, that the oversight of financial reporting should be something that within the organization, persons are confident that there's active participation of key personnel. And I'm talking not just the finance department, not just the CFO, I'm talking even at the board level and at the audit committee level. Over the years, one of the things I have always enjoyed as an auditor is having conversations with board members or an audit committee that it is clear that they are up to date and they are on top of what is going on in the organization and what's going on in the accounting world. It's so important to have persons participating in this oversight process who, one, keep abreast of the accounting standards, are prepared to push back, to question management. And, in auditing, there is this acronym that we are taught. And first you step into auditing, usually they tell you about CEAVOP: completeness, existence, accuracy, valuation, obligations, and presentation. And what they tell you is that these words mean something as it relates to the representation of numbers and information in your financial statements. And that is why it is important that the oversight process challenges the representations to make sure that these characteristics of financial reporting are met. So when we say completeness, what do we mean? We mean that all the transactions of the entity have been reported in the financial statements. There are no unreported transactions. Classic area where you sometimes will see a transaction not being shared: accruals, and especially with regard to legal matters. A big legal matter with the possibility of a claim having to be paid out maybe in 2-3 years from now for $500,000, $5 million, not recorded. Why? So we're not linking the international standards of the international financial reporting standards to the financial statements, and therefore our financial statements are not complete. So one of the things I'd encourage us is that look to see, are the financial statements complete? That's a key part of the oversight role. Also, do the transactions exist? And therefore your financial oversight role should make sure that you can establish that everything in your financial statements indeed exists and is of propriety, that it's accurately recorded. That's what the A stands for. And for the V is about valuation. Now, there have been a lot of changes in accounting standards. And as we get into the more complex and more advanced organizations, you will recognize that the accounting standards require a lot of information about valuation. What is fair value? And so it's important that that particular requirement of your financial statement is also, a process is in place to make sure that you're able to meet this. And of course, in terms of making sure that all your obligations are included. And then the P, a lot of people don't necessarily pay a lot of focus to the P, which means presentation. Why? Because you're just thinking, well, I just put things in expense and I can categorize, an asset anywhere, liability anywhere, but no. It is imperative that we indicate a non-current asset from a current asset. It means something, and it will matter to you too as you measure performance going forward. So, as I've indicated, my perspective on this particular topic was, it's great to have structures in place, but it's more, to me, it's more important for the active oversight of the financial reporting process. And what does this active oversight look like? When we even when you look at your audited financial statements, as an audit committee, your role is not just to accept whatever, to one, engage the auditor, to two, look at an audit plan, and then three, sign off on the audited financial statements. Your role is to question too, question the auditors as well. Look critically at their plan and also challenge them in terms of any recommendations, any changes they may be suggesting. Not to say that you are just challenging for challenging's sake, but make sure that at the end of the day, the representations contained in the financial statement reflects your business. And, just to close my opening remarks, I also want to say that this active oversight of the financial reporting process, which to me, if that happens, really enhances the public trust, because the quality of the document that comes out from the organization will be so much more different. The reality is then that all participants in this reporting process need to make sure that they are up to date with what's happening. Let me tell you, where the conversation now is around financial reporting, people are not talking about IFRS anymore. People are talking about IFRS is a given, right? When, for example, I had a financial reporting, I went to the IFRS Foundation conference early June. And most of the time, it wasn't around, IFRS 1 or IAS 2021. They're not interested in that anymore. They've moved ahead and looking forward to things like integrated reporting, looking at sustainability reporting. And now, even more critical, is the attempt to move to reporting the possible impacts of climate change on an organization. So we have to, as a Caribbean people, and as well as organizations in Trinidad and Tobago, recognize that this role of oversight of the financial reporting process is very involved, and it should be actively demonstrated in the day-to-day, in the overall management of an organization. And I would strongly encourage us, as much as possible, to engage in, whether it's research, whether it's CPD training, to keep up to date, so that whatever we present to the public gives a very fulsome story about what the organization has been involved in. Thank you.
Thank you very much for that, Stacy-Ann. I appreciate that contribution, that oversight is an active process.
Yes.
We will delve into that a little bit more when we get
Sure.
into the discussion phase. So at this time, I want to invite Claire to give her opening remarks.
Thank you very much. I must say that my internet is a bit unstable. So Stacy-Ann, if you can take over from me whenever it is that I fade away. So that's our backup plan. And if it's terrible, I will just switch my phone and call from my phone. So I posed a question to the participants and it's only one answer that I got, which is D. Can I give everyone another minute so that they can go through the question that I posed? All right, so we're looking at the role of the Board Audit Committee and Board in oversight of the financial reporting and rebuilding trust with stakeholders. And the question posed to participants, in which they were asked to select either A, B, C, D, or E, will be does the oversight of the financial reporting start A, with the presentation of the draft audited financial statements to the Board Audit Committee and Board? That is, after it is that the audit has already been completed and now management is and the auditor are seeking to get board approval for the financials. So is it A? Is it B, when the audit begins? Sometimes the audit may begin mid-year, sometimes maybe in the first quarter after the end of the financial statement. So does it begin, does the oversight start there? C, at the start of the financial year being audited. So if it is like, for instance, we are being audited for this financial year, is it that we are now going to start in January of our financial year that ends 31st December 2021? Or D, 12 months before the start of the financial year being audited, which means to say that if we are preparing for the financial reporting for the year 2021, should we have started since last year, January 2020? or E, any other? Please state when you believe it should start. So do I have any other answers apart from that D? One new message. One says continuous, okay. Which is your active oversight. But if it is, we are looking specifically for the financial reporting, let's say for the year end 2021. When will we be looking actively at what will impact 2021? Right, I like the idea, right, continue. This should be an active and ongoing process. All right, so far our top 3 answers, 2 for E and 1 for D, right? And I would want to say yes, at minimum 24 months. Don't wait until the year end when the auditors are now going to give you what is the financial position of that year end, that you're now starting to look at the financial reporting for the organization, that if it is that you want an unqualified or a successful audit. Now right, I'm seeing another D. Thank you very much. So I'm getting some excellent answers. Right? So a lot of directors, and especially directors who are now starting, or even management who might now be taking up the position of chief financial officer, etc. Sometimes when they are faced with what you call management representation or the company representation that must be signed by the directors, yes, that is the time that they recognize that, oops, all of these things I'm signing and certifying my life away to. When in truth and in fact, that's not the point that you're really, you should now be considering what you're signing to. Because you're now certifying to the internal control system for the organization that all of the claims made by and against the company duly recognized in the financial statement, that you have policies for the all of the accounting treatment, yes, that will impact your financial statement, that your fraud policy is in place and has been disseminated and has been lived by the organization, you know. So you cannot wait until you're called to sign off on those management management and board representation for the specific audited financial statement before you start your oversight duties. So your oversight duties must at minimum start 24 months before, or as we said, an active and ongoing process, be continuous. Now, when it is that you're looking at the agenda for your board audit committee, and if it is your board audit and risk committee, right? If it is that your agenda does not really reflect what it is that you as the directors have to certify at the end of the year, when you're faced with approving the audited financial statements, then it means that you have not been doing continuous or active oversight. So I would want to say that boards must consider what it is that they have to actually certify to, and to make sure that they start with that oversight up front. And then concentrate now on what is that they have to put within that organization that will give them what management overall, the directors and the board will be certifying thereafter. And just to state, so that we can understand the context, right? So the board audit committee and management must ensure that the company's financial statements are presented fairly in all material respects in accordance with international financial reporting standards. So if it is that the board and management are not aware of the requirements stipulated by those standards, or emerging standards, and sometimes emerging standards require you to even change your accounting system, yes, to redo some of your policies. So they really and truly create some fundamental changes within your accounting and financial reporting. So it means that you cannot wait until the auditors are present and then now start looking at your oversight. So you have to make sure that there's an understanding of those financial reporting standards, that whenever there are new and emerging standards, that the directors and senior management are fully accurate with those standards. So there must be a training element for your directors and your management team. The auditor's responsibility is to conduct sufficient tests for the purpose of expressing an opinion as to whether these financial statements are presented fairly in all material respects in accordance with international financial reporting standards. So your auditors don't prepare your financial statements. That's management's responsibility. So it means to say that if it is that you are not preparing your financial statements on a monthly basis, quarterly basis, making sure all your reconciliations are being done on time, right, completely, yes, it means to say that at the end of the year, when your financial reporting, I should say the audit for your financial reports for that year starts, you're already behind. It is already too late. When you look at the statement that, which is the financial position that the directors are required to sign, when you're putting down your signature to these documents, it can be a bit daunting, yes, especially if it is that you did not do your homework up front. So I think at least, even when you have done all it is that you could have done, it is still a bit daunting when it is that you have to sign off, because you're actually signing off, and I'm looking at a separate statement of financial position for the company, yes? That the directors have to sign. So you as the chairman, you have to sign, and then most of the time you'll use the chairman of your board audit committee to sign off, because the two of you alone not going down. So it means to say you must have a partner in crime. So make sure you bear that in mind. Oh, I'm having my turmeric tea. So so if you see anything yellow, don't worry. Yes. So it starts with assets. And all of the assets of the company, you are now certifying that yes, these valuations are true and correct, and all of your assets are so stated and reflected in the financial statement within this one financial position document. So if it is that you don't have a proper valuation policy, and if you did not value your properties during the year, early the year, or especially if it is that you may have a policy that says every year, then when are you going to do it? After the close of the year? At the beginning of the year? When? So the timing of your valuations, the completeness of your valuations, and also the what do they call the hidden assumptions? Yes, see Stacy-Ann.
I mean, no, you're correct. The exact word is the assumptions and the unobservable inputs. Yes.
Otherwise, your valuation will fail.
Yes.
Yes. So you have to understand as a board, what are the fundamental principles for your valuation? So and I would want to say that given my lifetime, valuations used to be just the management team coming to say that, okay, yes, I think I offer 10% on this value. Oh yes, I think that the marketing, what is it, the market price will be X, and that is acceptable. And the auditors will say, well, okay, sign here once it is that you are stating that these are your assumptions, and they're good enough. No, that is not so. So you now must ensure that even in the selecting of your valuator, that it's a reputable valuator, that the valuator is independent from the organization. Yes, that the evaluation reports that are being presented now have all of the necessary information that the auditors now can rely on. So a simple thing that used to be where management assumption and projections were quite acceptable, they are no longer so. So what you're starting to see in financial reporting is a lot more emphasis on your independent reports that feeds into the financial statements, yes, and credible reports. So you cannot just select a valuator because you were very happy with that valuator 20 years ago. If it is that when you assess that valuator, you recognize that the valuator no longer has a credible team, it doesn't make sense that you retain that valuator. So even in the request for proposals for your valuator, you have to ensure that this valuator can give you exactly what you need, so that you as the directors at the end of the day can certify that yes, these are my assets, these are the values of my assets. Yes. Equity. It means to say that you now have to make sure that all of your equity, your accumulated surplus, your valuation reserves, your share capital, everything is accurate. So it's no longer that years ago where it is that you just used to leave that as a figure that balances off the balance sheet. Remember that time? You just leave it there. Whatever is missing, that belongs to equity. But the shareholders don't come in and test anything. No, that is not so. So you must be able to have your equity valuations current and also compliant, because it doesn't make sense that you're stating that these are your shareholders and your beneficial owners, etc. And when you go into the company registrar and you look at the legal documents that you're required now to file, or even know your customer, know your companies, etc. and whatnot, you're seeing the information is not consistent. So there must be consistency in your shareholders' information. Who are your shareholders? Who are the beneficial owners, etc. And all of that rolls into your financial statement. So financial statement of yesteryear compared to what is now and also what is going to be, totally different. You have to understand the changes, and you have to understand that change management is just not a system development project with your IT people leading it. It's no more than that. Yes, so the directors understanding what is required and what they will be required to sign thereafter is very important, because that allows for that continuous ongoing oversight. Yes. Then the liabilities. So all liabilities must also be reflected on that financial position that will be signed off. So your total equity liabilities, your total assets, etc., on one sheet. So it appears as if it is a simple document that you would just be signing. In truth and in fact, you have a lot behind that document. So the directors must ensure that throughout the year, the minutes of the board audit and risk committee, the minutes of the board clearly demonstrate the level of oversight that is displayed. It can't be that the last month before the auditors are leaving that, oops, we are now trying to put everything together. It does not work that way. Yes, so everything must speak to that. What is it that we have to do as directors for our financial reporting? Kamala, you need to give me some timekeeping or Safiya.
Yeah, you only have like just about 2 or 3 minutes again.
Really?
Thereabout, yes.
Okay then. Well, let me state some of the other areas where it is that ought to be on the agenda of the audit committee for financial reporting. Your trade receivables and what's due from related parties. So if you don't know your related parties, if it is you don't have a policy to guide you with related parties and related party transactions, it means by the time that you are getting ready for that, the audit for the financial statements, it is already too late. So it means that you must establish your policy for related parties and related party transactions, and you must understand your trade receivables. So at all of your audit committee meetings, you ought to be seeing reports on the trade receivables, what you'd call your bad debts, how are they aged, how you are dealing with them before they become uncollectible. Your litigation and claims, you must have that on the agenda. That's to make sure that any potential liabilities that will be coming against the organization, you're quite aware of your whether it is that you have a strong case or not. If you have a strong case, then you can say, well, okay, it's more vexatious than anything because anyone can sue you. You don't want to bring all of those things in. But at the same time, there will be some credible matters. And as such, you now need to consider what's the potential of success and how can you ensure that you don't have to provide a provision for any legal losses that you may suffer. The COVID-19, a lot of us don't understand that COVID-19, you have to make sure that you have an update, that the directors are quite clear as to the impact of that COVID-19 on the organization, and the impact on your going concern. Yes, all of your new strategies that you will be developing to deal with your business continuity and the future success of the organization. So that has to be brought to the audit committee so that the audit committee can understand that risk of COVID. You're also looking at risk management, right? And that is why now you'd find that oftentimes you will see the board audit and the risk committee. So it's not only the financial risk, but the risk of the entire organization can very well be under the direct oversight of the audit committee. Again, if it is that you look at your financial statements, you will see a lot of the risk that will now be stated within the notes. And sometimes we miss that. So if you look at all of the risk that the company must demonstrate that it is actually managing, and what is the risk management policy that is in the organization, especially enterprise risk management, not only financial risk. Fraud. Because if it is an organization where the control environment is weak and the ethical climate is poor, it means to say that you're more likely to have fraudulent financial statements or misrepresentations, deliberate misrepresentations within the financial statement that can be deemed as criminal act or criminal negligence. And that is a direct risk to the directors and your officers of the company. The strength of your management team. So it's not as if it is that you're going to just cut cost and decided to bring, as I say, when you pay peanuts, you get monkeys. You can't afford to have a weak management team. And as I said earlier, you need to ensure that your management team is trained and developed even in the IFRS. Another thing what companies tend to face is the belief by management that it's only the accountant and the chief financial officer must address the auditor's concerns or respond to the auditors. Yes, and it's a vexatious issue if it is that the managers are called upon to provide any information to the auditors, and that is not so. At the planning stage, all members of your management team must be brought in, must understand the audit is going to start. And all of your internal control systems that you ought to have drafted since last year, 24 months before, and operationalized, guess what? You now have to answer. All those incomplete records, all those failure to ensure that what was supposed to be signed off was signed off, what was supposed to be verified, what your quality management system supposed to be enforced. Yes, all of those things, if management is not aware that they are responsible and accountable for ensuring that the information that they provide to the accounting unit is accurate, it means to say that the audit will fail. If it is that management doesn't understand that all of their transactions must reconcile, must get into the general ledger, that they're responsible for that. Yes, so I would want to say that overall financial reporting is not just when the auditors come in to start their planning, it's long before. It is not when the auditors are present and everybody says, oops, the auditors are here, right? It is not when it is the audit is going to start and you're now being faced with the management letter from year before and you say, oops, let me see, because the auditors are going to ask, did we complete all of the recommendations that were within the management letter? Yes, it means to say that you have to be able to start implementing those recommendations from the moment the auditors had a discussion of their concerns, which meant that it is even before the management letter comes in. So you don't have to sit down and wait and see, well, if I don't get the management letter, then I don't have an issue. It means to say that if your company is saying to you, if it is you have a breakdown that the auditors have reported as a weak control, we should not be seeing a repeat of that issue. So you should not be seeing a repeat in the next year's management letter. So it means to say that management must start implementing those recommendations and ensuring that you don't have a repeat. Yes? So I would want to stop here, and I would want to thank the participants, especially those who responded, and they understand financial reporting and what it is all about. Thank you very much.
Thank you so much, Claire. I think you provided so many jewels in terms of practically how an audit committee can go about ensuring that, and I think that is so valuable. So at this time, we want to welcome Mariano to give his remarks. So Mariano.
Thank you. Not certain what is left is to be added to what went before. I do in one of my roles, both as CEO as well as a member or chairman of the audit committee of a publicly listed company, have to live with some of the advice that was included in those statements before. And I think it's important also to give a little brief sort of background to how we have arrived at this particular point. And the idea and the search for, if you will, certain common principles of corporate governance have largely taken place as a result of certain kinds of excesses. And the excesses where publicly quoted companies have not reported in a fashion which is either complete or accurate, or that evaluations which are included therein reflect reality. Hence, the auditing profession has found itself in a situation. We've come from the big eight, just about to the big four, And I think the attempt is to hold the line there because it hasn't stopped mistakes from taking place. So the issue and the movement has been, and the auditors, and certainly within the auditors that I've had to deal with, in the sense of those who are reporting on what I have to do and those that I have to work with as an audit committee chairman, have reached to the point that generally speaking, they want evidence, they want analysis. And given the difficult times in which we find ourselves in the Caribbean, particularly with regard to foreign exchange, and also given the impact of the closure, business closures that have taken place with regard to COVID, the issue of going concern. So you would find that the auditors have started to pay attention not only to the reporting on the accuracy and completeness of the financial statements this year, but also to take into consideration the future year's performance, in which case to evaluate the capacity of the company to survive. Because there's nothing more embarrassing than have given a clean audit report this year, but within a very short time thereafter, there may be issues of insolvency and or the company runs into difficulties, which puts the auditors in jeopardy and their reputation in jeopardy. So the point that was, I think, first raised by the first speaker was the issue of public trust in the completeness of those records. And the OECD corporate governance guidelines, certainly on disclosure and transparency, are well worth following, and they dovetail with everything which has been said. And those really deal with the issue of disclosure. Why disclosure? Well, because some of the biggest issues have been about not so much disclosing non-relevant issues, but that the numbers, such as they have been published, are akin to what one would call fiction. And we had the Enron disaster. Well, disaster in a sense, disaster for the auditors who were concerned. Literally, that audit company literally folded up. Its demise was due precisely the fact that it had given a clean audit report on a balance sheet which contained significant issues of valuation and incompleteness, so that they didn't survive that particular one. So that the standard, the bar for disclosure has been raised, and the disclosure provisions, not that when I say the standard has been raised, the standard has been raised to ensure that you're reporting and you're reporting completely. And we've had within the last 5 years, another such example of what one would call, if not fictitious accounts, certainly upon an official Ponzi scheme, which seemed not to have been discovered before, and that's Bernie Madoff. So the fundamental issue that we always come down to is to ensure, and this is where the OECD governance principles fall into position, that you want material information on the financial performance of the company's objectives, who owns the company, who has voting rights, who is going to make a difference, what is going to take place, right? Who are the members of the board, the key executives, how do they make decisions, what are they being paid for? Because of course, the bottom line is if executives are being paid on certain types of performance bonuses, there could be the emphasis on the short term at the expense of the long-term survival of the company. So that people, and that is increasingly being an issue. And you saw it borne out in recent times where people have started to object to the compensation which has been paid to executives. Within recent times, looking at the longer term future of the companies, we've seen both in the case of Exxon, certainly in the case of Shell, and the case of BP, where shareholders have agitated, not only with regard to remuneration, but also to the long-term viability and the impact of those companies on the long-term health and climate change, because they operate in specific sectors. So much so that the court in The Hague went so far as to indicate that the company had a responsibility to the wider public. Now, of course, that's going to be contested over the next couple of years in terms of how that falls. But we're going to see how it turns out, because there's a wider issue, and I think that was alluded to early on with regard to disclosures and wider issues of disclosures, not just simply on the liabilities and or the value of the assets of the company, but in terms of its impact and its role with regard to certain operations within the society. And that is going to become an increasing feature in terms of audit reports, which, for example, deal with the positions on climate control. climate change, not climate control. And also to what one would call measurable and foreseeable risk factors, which are also included within the purview of the management of the company, as well as the certainly the audit committee needs to pay attention to those matters as well. Other issues, of course, relate to the wider issue of employees and stakeholders and governance structures and policies. Now, I think that's reasonably straightforward. We understand that what is taking place is that we are actually improving the audit systems and mechanisms as we move forward. Certainly the changes in the FRSs and some of the other measurement attributes do require a different level of skill and perhaps emphasis on certain other areas which are not normally considered within the ambit of adequate financial reporting. But I want to put it on the table as well, that while we pay such great attention to the issue of corporate reporting, that perhaps, and also corporate responsibility with regard to how those reports are framed and delivered, that we also need to pay some attention to the issue of fiscal responsibility in its wider sense. And what do I mean by that? Well, having worn the hat of a minister sitting in the Ministry of Finance and having to deal with state enterprises, as well as the business of preparing annual budgets, there's also the issue of fiscal responsibility. Fiscal responsibility in its widest sense. Now, they don't have directors in government. What we have is ministers, and ministers who are appointed technically to fulfill a political role. But we also have to understand that at the end of the day, particularly in economies such as ours, that government's responsibility, government's role accounts for a significant share of GDP. In some instances, government is probably the largest single actor in terms of its expenditure profile, and can count anywhere from 20% to roughly just under 40% of GDP, which is significant, right? But we tend to pay more attention to how the private sector reports than the quality of reporting that we get out of government. So the point that I would want to make from this perspective, and for some reason or the other, we think that some of the other government reporting is something that is different, a financial responsibility, we tolerate that. Well, given the fact that it accounts for such a significant share of GDP, it means that we have to pay a different kind of attention to the quality of the results which are published therein and the public availability of the information. So, for example, the best-in-class principles have generally been the country that is used as an exemplar, for example, in this regard would be the New Zealand government and to a lesser extent the Australian government. There is, for example, a law which requires, if once you decide that you're going to call elections within, I think 14 to 42 days within that particular period, you must report what is the statement of the country's financial position. In other words, it becomes an objective measure of assessment. This is where we are. So if we're going to talk, and we're going to talk on public platforms about what is the state of the country's finances, well, here are the numbers. It isn't going to be based on the basis of allegation. Now that sets a tone and a situation for responsibility, all right? And in the sense that not to say that there aren't going to be different interpretations. There are always different interpretations when numbers are concerned, but it does put certain information in the public domain, which would normally not be in the province. Now, I'm putting that as a rejoinder, and the point I'm making is that the same way that we want to talk about corporate governance and governance of individual enterprises, the fact that government is also a significant share of GDP, it also requires some framework within which that fiscal responsibility, and by fiscal responsibility, I mean budgetary estimates and so on, are presented and are adhered to. There have been some instances, for example, within recent times, where there's been some differences of opinion with regard to what is the size of public debt, what is public debt, and also to some estimates, for example, in terms of what is the reliability or the strength of National Insurance Board. Those are not things that ought to be in doubt. The information ought to have been straightforward. People ought to be able to see what the information is. It ought to be presented within a reasonable time frame. Right? So for example, it's impossible and ought to be impossible that reports for, say for example, a public entity like National Insurance Board, which has statutory legislation before it, which insists that reports should be presented within a particular time frame, that those reports should not or are not being presented in that time frame. So that responsibility exists at twofold. This is the point I'm making. Responsibility exists in the level of a corporate world, but we must also ensure that the level of responsibility also exists in the public sector. Why? Because the amount of resources that we're talking about in the public sector parallels that of the private sector, and in some cases are bigger than any one single entity. So it's important that we keep the reporting of those matters under our purview and within regular time frames. So they ought not to fall out, or we forgot to do that, or we didn't do it at all. I forgot about that. That's akin to a company not presenting its financial statements, for example, within 90 days at the end of the financial year. And at the end of 1 year, well, we didn't do it either. Those are the kinds of things that we have to prevent, both in the public and private sector, when we talk about corporate social responsibility and we talk about principles of corporate governance. The principles of corporate governance don't only exist with regard to the firm, they exist with regard to the public sector as well. And we need to start paying attention to that behavior in the public space as well. In the same fashion that we want people to have trust in the financial statements, therefore we want people to have trust in terms of the future of our country and also its manageable risks, which are meant to be seen or foreseeable. Right? There will be things which will change, but at the same token, there must be an organized methodology in terms of dealing with those changes. So the point that I want to make today is that the same principles that we apply to corporate governance with regard to the financial objectives, the operating objectives, the company objectives, right? Those are issues which are parallel at the level of the public sector, for which we do not pay the same level of attention. And we do not apply the same standards of care, right? And there's some examples which would crop up to mind, which would come to mind immediately, right? Reporting on the basis of cash reporting leaves considerable room for maneuver. So, for example, you can very well overstate revenue, for example, at the government level, for a very simple reason, by suppressing payments to creditors, suppressing payments to suppliers, and suppressing tax refunds, right? In which case, we push that down the road. That's window dressing of the first kind. So the principle, if we want the principles of corporate governance to be held in the private sector, we must also have those principles of corporate governance which are upheld in the public sector as well. Why? Well, for the very simple reason that the private sector depends on a framework of rules and regulations, which eventually is managed by the public sector. Right? We loosely call those the ease of doing business. Right? And those are, in a sense, a rule-based format, a rule-based entity, where there are certain presumptions. And one of the things that you would look at in terms of the flow of investment capital generally tends to flow to those countries which have reliable principles, a reliable corporate framework. And what we call exploitation in terms of political economy of multinationals or what one would consider developing countries, invariably is a reflection of the weak corporate governance structure, both at the level of private sector and public sector in some of those countries. And as a result, what do the multinational companies do? Well, it makes certain they move as much money out into the countries where they figure they are relatively safe. Because at the end of the day, that's the fundamental purpose of corporate governance. It is about ensuring an environment which is consistent, which is stable, which is fair, and which operates well on a consistent basis. And therefore, if we want any country to operate on a continuous basis, and we want the private sector to grow strong, we want corporate governance principles to be well adhered to, right? It's important that those principles that exist in the private sector exist in the public sector as well. And I'll leave it at that. Thank you very much.
Thank you very much, Mariano. I quite enjoyed adding that perspective of the public, having worked in both public and private sectors myself. So while we're getting ready, so we want to ask the participants, get your questions ready and put them in the chat. But while you are doing that, I want to open up the floor to Stacy-Ann again, seeing that she went first and may not have had the opportunity, perhaps like Mariano, to hear the first two persons go. Is there anything that you would like to say or add or respond to based on what Claire and Mariano said?
Thank you. You know, it's so interesting. 3 different persons, we didn't speak before, and bringing 3 perspectives that are incredibly valuable, you know, to the table. And these are all of the things that they've said must be considered. I actually want to put forward something that is applicable in all scenarios, and it's a tone that is set. What do I mean? In establishing an oversight process and the oversight team for the financial reporting process, I think a tone is very important. And I think all of the management experts online here would definitely appreciate that the tone you set is key. What do I mean? If a board, for example, or your audit committee is quite comfortable with the auditor being responsible for making the accounts correct at the end of the year, take it from me, you will have a situation where your management accounts mean nothing. They are not worth the paper they are printed on. A different scenario though, and I remember going into an audit committee and I saw this happen and I was like, just so pleased. I actually, every time I go into this particular audit committee, I say nothing except to confirm whether or not the financial controller was telling the truth. The board chairman, the audit committee chairman, turned to the CFO and said to him or her, please take us through the accounts. The person who had to take the entire audit committee through the accounts, he then turned to me and he asks me, is this your understanding from the work you've done? And I would indicate yes or no, and I'd indicate if there are any challenges. When there is a difference from the audited and the management accounts that would have been prepared, there was a consequence. So what the audit committee, the tone the audit committee had set is, listen, you have 12 months to do a particular work. We want you to do a good job. Now, what the auditors should be able to do is with some ease, basically confirm what you've been telling us the entire year. So you think about it, a whole year you're getting management accounts. And then when the financial statements are audited, you're seeing significant changes. Think about the decisions you're making. You clearly have been making decisions on information that is so wrong. And not only that, if you wait on the audited accounts to make your decisions, you're making decisions on information that is old, incredibly old. So I must admit, just to add to what has been said by the other participants, the only other piece that I'd add is the tone that your audit committee sets. And let me tell you, you're only able to set that tone if you know. So who make up your audit committee becomes critically important.
Yeah, thank you so much for that, Stacy. In fact, as a leadership professional myself, I mean, I'm a chartered accountant and I have my own start in audit and in accounting, but there's a piece of research out of Harvard that talks about whatever is the value system displayed by your key leaders, that is what will go through the organization. That's based on research of thousands of companies across the globe. So that tone at the top, that tone at the audit committee, it will show itself in what comes out at the end. Definitely, definitely. So Claire, do you have anything that you would want to add to Mariano's submission?
Yeah. Well, I totally agree and support all the statements made by my fellow presenters. What stood out for me is what Mariano said at the end of his presentation, is that it doesn't matter whether it's a state organization or a private organization, etc. It's the same standards, the same governance principles, it's the same IFRS. And I think a lot of us tend to forget that. And that is why when we are speaking regardless of whether it is a private sector, public sector, listed, unlisted, state enterprise, even the ministries. Because, for instance, let's look at the ministries. Yes, the auditor for the ministries is really and truly the Auditor General, and they are required to look at this the same accounting for public funds. The same way that you would want to account for your private funds. The shareholders is the same way, it's the same approach, right? If it is that you have weak internal controls, regardless of whether it's a KPMG or a PwC, yes, or EY, or it's the Auditor General, it's the same type of testing that they do, the same type of reports that they do, the integrity of the financial statements and the financial position of the organization, regardless. Yes, they may have a different accounting system for public funds within the ministries, but at the same time, even that and all is starting to change. So you're starting to see the accounting systems for the government, the government sector. Yeah, it's changing, because before they didn't used to do any accrual accounting. So it is just that what I spent today is what I'm accounting for. And you're not seeing that anymore. You're seeing a lot more movement towards the public financial management that is pushing through on what is it that you now need to display, right, to report to the public, the man in the street. So it's no longer what you think that you want to spend and then that's all that you're accounting for. What's your actual spend or your actual receipt? It means to say now that you have to deal with what are the commitments that you have made that you have not spent money on yet.
Yes.
Those are liabilities that you must record and you must display. So that if a country is going bankrupt, because it's just the same way as a company will go bankrupt, because you have already made a lot of commitments. So you cannot tell me that you're going only against your budget. You have to tell me what are the liabilities that you have now accrued that you don't even have the money to spend on. So I think the reporting by the government consistent with the any other organization, be it private sector or be it the state enterprises.
Right, thank you for that. Okay, yeah, so I wanted to get to the point of us linking it very clearly to trust, building that trust with stakeholders. But before we delve into that, and if there are any questions from participants, I want to engage Mariano from the perspective of, so audit committee, you understand very clearly in a private entity that the audit committee generally is the body, the organ that has the oversight of financial reporting. In the public sector, who will pick up that role? Just to make it a little clearer for the participants, who will take that parallel role in the public sector?
Well, the public sector has the Auditor General, and the real role and the real place where that should be debated or handled is. That's why the best practice is that in large measure, you set out what your objectives are by ministry. Right? We set out, in the case of Trinidad and Tobago, as in many ministries in the Caribbean, we set out how we want to spend. We don't calculate what is meant to achieve.
Yes.
And that's the difference. I mean, that's a critical issue. If we really want to use, meaning the lesson comes from the private. If we're going to spend X amount, then it must be objective and objective of public policy. So the real issue in terms of these things to widen the sort of range of, not to widen the range of variation, but in fact to narrow it. Right? You really want them to focus on what are the objectives, how much money is spent in terms of getting that objective. Now, that is where our concepts of fiscal responsibility fail in comparison to the private sector. So there's a huge, I mean, people talk about the budget all the time. They talk about what the budget is meant to do and so on. Right? really doesn't come to any sort of definitive conclusion as to whether we were more resourceful, whether we were more efficient or other. It gets lost and it trails off. And the reason for that is that we're not focused on our objectives. That's one critical thing. One of the critical things that needs to change, I think, at certain level. That's also the message at the level of the private sector. Of course, the private sector can bring it all down to a number, whether we made any profit this year or not. And that's one of the reasons why I said that given the trying times in which we have found ourselves over the last 2 years, we found that the auditors are looking at going concern, reasonableness, continuity, follow through. That is not just simply about the results that we're producing this year, right? But it is about our capacity to survive the difficulties that we have in front of us. Now, failure is an indispensable part of success. And in the private sector, we recognize that there will be failures from time to time. But those failures exist and can take place because there are rules of law which allow, if you want, those failures to be dealt with in a wider context. Now, the same doesn't exist for government, right? If government runs into trouble, everybody's in trouble. So the point I'm making is that the same way that we want, and I don't get me wrong, I am saying, and I recognize there may be some limitations in terms of the applicability of governance principles that we follow, right? In general terms, there is not, and there ought not to be any distance between them. Right? It's just that what government is more cumbersome. The state has, for example, approximately almost about 50 corporations which fall within its purview and its jurisdiction. But that alone gives some difficulty, and that's one of the reasons why the rules have to apply consistently as well. The state-run entities, they have to be very consistently applied, because at the end of the day, that's our money. Right? The same way that the shareholder is puffing up money and he wants to see the company perform well. Well, by definition, we also want to see the same thing take place at the level of our government. So I make the principle, and I made the link because generally speaking, we focus on the private sector. This is not to say that the private sector doesn't have any infelicities or any mistakes. They do. Right? But the abilities of variation are infinitely larger on the other side of the fence. That's why we need a rule-based framework. And that's why we need to pay attention to it. The point I'm making is we generally do not pay the same level of attention or apply the same level of principles at the level of, if you want, the wider perspective, the state in terms of its fiscal responsibility. Right. I'm just making the point that we need to apply that too.
Yes, and point well taken. So I want to open the floor. If there are any questions from the participants, please put it in the chat. I want to ask, I remember lecturing some years ago on a master's program, and we were talking about how financial reports are available, and many of the stakeholders who need to rely on it, they don't read it, they don't keep up to date, they don't take it on. So the question that I have, and that's one side, and then I was speaking to some CEOs, and they felt that going to invest, because it is an investment, to ensure that you have your oversight set up properly. Claire talked about training of the management team and ensuring that you have competent management team, and there's so many different things that you have to spend money on and continue to do. And some CEOs and boards feel that it is a waste of resources and it doesn't result in their main goal, which is profit maximization. How would you respond to that?
Who are you asking that question to?
The entire panel. Whoever wants to take it, you can go at it. Because it's I mean, I've heard it. And what would you say to those kinds of CEOs?
I will speak as a CEO wearing that hat. The strength of an organization is the capacity of the organization to succeed. The capacity of the organization to succeed is the capacity of the human resources to be able to respond to different stimuli in the external environment. One of the things that we have learned from medicine, and that we ourselves as accountants, and in some areas we do it, is the one of continuous learning. We call it continuous professional education, right? Or continuous learning. the application of risk management principles to business is not, it's actually, we borrowed it from the medical fraternity. And the medical fraternity has learned that procedures change, right? We learn in the process of doing things that there are different ways to do business. The general practitioner who went to school and 40 years ago and is still practicing the same thing he practiced 40 years ago is doing a disservice to his clients, right? So that at the end of the day, the same thing would exist in business. We have a responsibility to make certain that the company is always tuned. And by tone, we mean not only a timing, tone, and tempo, but we also mean that it has the intellectual capacity and the people capacity to respond to the external environment. Consider the situation in which we find ourselves in at the moment, right? All over the world, supply chains are now being, I wouldn't say crushed, but they're being attenuated. We have all different kinds of things which are taking place. The containers in the wrong place, complete. So shipping rates have increased by a factor of 100%, right? In some instances, right? They've doubled, right? So we have a whole series of problems. Now consider, for example, if your people aren't sufficiently trained, and what Claire was saying, the point that Claire was making with respect to preparing for the audit. Well, the same thing with regard to preparing for your supply chain. What are my alternatives? Who do I go to? How do I keep my cost in control? Because that's a company could die on that basis. Right? And those are issues those are real issues. So there's no substitute for trained people who are knowledgeable, right, and capable.
Right.
Can I add?
Sure, I was actually going to go to you because I saw your facial expression, because I see two very clear groups of business leaders in the market. There are those who are very clear on the benefits, the role of financial report and its oversight, and there is another group who thinks they will only do just the bare minimum to tick the boxes because it is just too expensive and it doesn't make sense from an ROI standpoint.
Yeah, I have been in this accounting thing for about 30 years now, a little bit over 30. And what I've come to learn is this: when you cut corners, you're going to pay. If you have a hotel and you're running the hotel business, and what you do is that you take all the profits as your own, you don't build up a set of funds, a reserve fund called like a replacement reserve fund, etc. There will be a time when you have to replace, you either have to go expensive and take a very expensive loan because you did not do what you needed to do from the earlier stages. And over time, simply just put aside certain funds so that you're able to respond when there is a crisis. Many times our business people do the same thing. You don't look, you have a complex organization, but you don't get the appropriately skilled people to assist you in telling your story. And then one day you're going to need a loan, or one day you want to be listed on a junior stock exchange, or one day you have to tell a different story because you want to be seen in a different light. You will not have that credibility because the story you're telling, when tested, will not be able to stand up. And I've seen it over and over. I've seen people take aggressive tax strategies. And at the end of the day, it comes right back to bite them, because at the end of the day, what makes best sense is a balanced approach. I must admit too, and what I do hope is that more businesses are seeing this, that profitability is not the main driver anymore. It is a key driver, don't get me wrong, but it isn't the only. Maybe what I should have said is, it is not the only driver anymore, because there are so many more tangible and intangible benefits from a business that protects its sustainability when profitability is not the only driver.
Yes, thank you for that. Claire, anything you want? Yes.
Yes, I think, yes, I will have to chime in here. developing the management team is really key, you know, and because the company cannot run on its own. It cannot run with the directors because the directors don't execute. They cannot execute. The chief executive officer, he will not have the expertise in all of the functional areas. Yes. And the leadership style, if it is that you're looking at from the functional areas, they are going to be different. Management and leadership, totally different. So it means to say that how do you really and truly pull that team together so that they can set that tone? Because you can set the tone in the board room. You can say to the management team, this is how I want you to function. But really and truly, if it is that the leadership team is not walking that talk, they're not seeing the directors. They're not seeing the directors. So it's that leadership team that will make the difference for the organization. Yes, and fundamentally, they must be told that they are not doing things for the auditors. They are doing things for the organization and what's the best, what's in the best interest of that organization. Yes, and think it through. Ethical, compliant, risk intelligent, a learning organization. Yeah, all those sort of things, they have to live it. They can't just say that, okay, the auditors are going to be coming in, or I need to get a report out to the public, or somebody's asking, yes, a stakeholder is asking me, what are our thoughts on this matter? It means that you have to live it. You cannot wait until you have to demonstrate, and then all of a sudden, you're now thinking of it. It has to be within you. It has to be ingrained in you. So every decision that's being made, that the leadership team is making outside of that boardroom, means to say that they have to understand the impact on the organization. Yeah, it's not for the short term, it's for the long term. Whatever decision that they are making, what's the pros and cons? Simple, right? What's the risk impact? Right? Do we have the risk appetite? Yes. How do we make decisions? Another thing that you may find is that there are organizations where it is that your leadership team might be predominantly certified professionals. So that continuous professional development is forced by the professional organization. Where it is that the majority are really coming through from the universities and they are with degrees. Yes, unless the company itself sets a policy that you must demonstrate that you have continuous professional education and put in that program for that leadership team, it is not going to happen. Correct. Have a degree, they might have a doctorate, but guess what? After 2 years, that's already obsolete, but they don't think so. Yeah. Yes. Yep. So what you want to do is to ensure that you enforce that learning organization. And as I said before, they have to walk that talk. The directors are not the ones in the limelight. The leaders are, and I'm saying the leadership team, not managers, not the officers of the company, because sometimes the officers of the company are not even there walking the talk. So your chief financial officer, your chief operating officer may be here, but really and truly, another position that might be critical may not be in that C-suite. You have to know now your leadership team may be the top, the ones in the C-suite, then maybe the next layer, and maybe up to your third layer, because you need to have that business continuity, that sustainability of whatever it is that is laid.
Sure, great.
Organization. You know, as I said before, and I keep saying it, it is not for the short term, it's for the long term. I want to sit down.
But Safiya,
hi.
Can I just say something?
There a bit. So I'm not too sure if you will finish speaking, but you're frozen and we're not hearing anything from you. So yes, Stacy.
I'm just if we just throw our minds back to COVID last year, March, when we had to face COVID in our businesses, March, April, I have observed that the more nimble organizations were those who were actively practicing oversight, where because they knew their business, they knew the customers, the financial reporting was on spot. They were able to know where money was, where their liabilities were. They were able to make decisions to move. Think about an organization that just for show has a meeting, listen to what the financial controller says, don't really understand the nitty-gritty, then they had a lot of learning to do to catch up, to be able to make a good decision to move you forward. These things are in place or suggested not because we want to, as an expense, but it's an investment. There's a reason why you need to have a business continuity plan. Who would have thunk that there would be something called COVID? I am halfway there, and I'm telling you, I never thought I would see something like this. I thought this is something for way back then or hundreds of years in the future. But the point I'm making is that you don't know when, and your team needs to be practiced in the abilities of being able to respond and to stress test an organization and to report properly so that decision making makes sense for the organization.
Thank you for that. Let me just read a couple of the comments that came in. So we have Misha, and this is towards Stacy. She said, you indicated that other governance structures are important, but more so the financial oversight. While I agree, I believe both are important because weak corporate governance framework or policies can be costly and impact the financial position of a company in one way or another. Yeah.
And I agree with Misha, except to say too, that really and truly as part of the corporate governance framework is financial reporting. Critical to it.
Yes, yes. Right, and then Ronele have a question for Claire. She said, how do you drive the cultural changes needed to have our regional directors understand the need for continuous learning to support long-term sustainability?
Right. And the directors themselves must have a training program, because oftentimes, if you look at the budget, you will see a nice budget for training and employee development, and then there is nothing set aside for the directors. There must be a budget for the development of the directors. It is critical when the directors first start within any organization that they go through that orientation program. They must start understanding the business. And then on top of that too, you now need to make sure that the expertise that they are brought within the board to share, that they are able to keep abreast. So for instance, you may have an attorney who is not, that your board is stating that you must have an attorney on the board, yes, or at least one director with legal expertise, etc., and whatnot, yes. It means to say that you have to provide for any changing legislation, etc., that director may also be trained the same, and sometimes you train them the same time that you're training your leadership team. Yeah, so don't be afraid to do that. They can be trained at the same time. Same thing with the financial expertise or on the technical side, etc. So the directors are just resource that is to be developed for the purpose of that organization. And as such, when they understand that it is necessary to allow the board to be an effective and efficient board, it's the same way that they will now understand the reason why you have a training and development program for your leadership team also. So they are not going to look at it, why are we investing in the managers? They will now understand the reason why we are saying a learning organization is every single person within that organization must have a clear understanding of what is required and necessary for that organization. And especially when you have changing environments.
Right. Thanks for that, Claire. So maybe I'm a devil's advocate to Mariano, jumping off of what Claire said, having worked in the public sector myself and seen how boards are selected. So I heard Claire say that, and I was saying, if the board is capable of being trained in my head, because sometimes they do not submit themselves. What is your perspective of that, particularly from the standpoint of public boards and having to submit themselves to the training program that may be set from the organization standpoint to ensure that they are effective?
I think the first point is that you want to pick people who can do a job. The job is to, keep the organization on a growth path, or alternatively to manage it more efficiently. So I think the first issue has to do with selection. unfortunately, sometimes board members are selected from a wide range of criteria, not all of which may be about the quality of the management skills. So the critical issue then becomes the chairman's role.
Yeah.
I'm speaking from practical experience here, as I say from any textbook. The chairman's role is a one, essentially has to keep the discipline structures at two levels, operational and functional. He has to keep the discipline level at the board level, and you have to keep the discipline level at the level of management. And the fundamental principle that I have always operated on in government, as well as out of government, is a very simple matter. Nose in, fingers out. Nose in, fingers out. All right? The different form of NIFO, right? Not next in, first out, right? Nose in. And in the bottom line, nose, because if something is going wrong and you smell is going wrong, right, then that's the time that you have to take action, right? Outside of that, don't get involved in the day-to-day operations. Yes, you have to learn about the operations. You have to know what is taking place. But most importantly, you have to understand the business. What is the business? And therefore, if something is going wrong, what are the pressure points? What it is that needs to be changed? And that training is also about keeping abreast of other developments. Well, the presumption is that directors do that on their own. Right? Those that are in the professions would or should, because they also have a professional responsibility. And if they fail in the corporate world, it invariably could affect them in their own professional life. So there's a presumption that they would follow through and work on that area. The second point from that is understanding the nature of the business. I think that's the most important point from the board, so that they can understand when something is going wrong. Right? Because oftentimes directors they have a helicopter view. They high up, and the devil is in the detail. That takes place on the ground, right? And most times, if you don't know the business, well, it could have any number of things taking place, and you wouldn't understand it, right? So that training in the context of directors is not necessarily textbook training. It is, in a sense, situational. And also, the biggest issue for directors is to understand what he ought not to do. That's the biggest issue. Because most times, especially on government boards, right?
Yep.
Directors get to live out their fantasies, right? They want to do all the things that they didn't do when they were at management level, or if they didn't make management level, they then want to become managers at the level of the board, right? Now that's where the role of the chairman is. The role of the chairman is really to keep them in check, right? Of course, so the key thing I would look at in terms of how a board functions is the capacity of the chairman to keep the board on side.
Yeah, thank you for that. I mean, and if the chairman is one himself or herself needs to be trained, you can see where
Well, then you're dead.
Yeah.
I totally agree.
Exactly so. All right, so we are approaching 2:30. The time went by so quickly. But what I want to do is to give each of the panelists just about a minute or so to wrap up, just giving your final remarks to the participant concerning oversight of financial reporting and rebuilding that trust with stakeholders. So let me start off with Stacy-Ann. Oh, you're muted.
Apologies. I will just quickly say that the chairman of the board and perhaps the wider board too should really think carefully about the key performance indicators that they expect, one, of board members, the audit committee members, as well as management, because I think this will enhance the oversight process, because you know what is expected now. It's expressed, it's measurable, and then you give them the ability to actively practice this oversight. Where companies do this, I think for sure the public trust is enhanced.
Right. Thank you so much, Stacy-Ann. So Claire, over to you, your closing remarks.
But I think we had a lot of food for thought, you know, and it was quite a session, I must say. Sometimes serious thoughts and learnings.
Claire, we're not hearing you. You're fading in and out. Because I know you said that your internet was unstable at the start of the session. So, right. So we can go to Mariano, and then hopefully Claire will be back in, and we'll just give her the opportunity to wrap up. So Mariano, over to you.
Just simply the title of the presentation and the topic today is about financial oversight. And to have financial oversight, essentially one has to have, as was pointed out by Stacy-Ann, a set of agreed indicators. And therefore, that fits in with the overall objective plan in terms of where we want to go and what we want to achieve. And once we have those in position, variations of the theme, of the meme, of the average, right, gives us an indicator, well, as an alarm bell that is ringing, and we ought not to wait for it to go too far, right? So that timely action, and timely action really requires timely management information. Timely management information requires adequate systems and adequate personnel to operate those systems.
Yes, thank you so much, Mariano. Claire, back over to you. You're back on.
Yes, I got lost with that internet. Yes, but so my message primarily is really and truly that sustainability, making sure that everything that we do, we must look at it from the long term. Even how we act, it's not that you can just gloss it over and you decide, well, okay, it's my mistake today, and I am not going to see the impact of it come tomorrow. So that thinking must be not only within the boardroom, but also within that leadership team, the ones where it is that they actually executing. And given that example, I think the development of that leadership team is critical for the organization, because directors can come and go. But if it is that you don't invest in that leadership team, it means to say that the organization will not survive. You will not be able to sustain. And also understanding accountability and responsibility. Once it is that there are too many gray areas in an organization, it's not going to work. The organization is not going to survive. So that the clarity around the roles and responsibility, and as Mariano says, fingers out, eyes in. And sometimes you have to put the nose in. You have to understand roles and responsibilities. The various leaders must understand their roles and responsibilities also, and must be accountable. Yeah? Those risks should not be rolled into the boardroom.
Yes.
Need to be able to protect the board and the directors from allowing risk from within the organization to roll up into that boardroom. So understanding the risk to directors and officers of the organizations, very, very critical. And continuous learning is a must. Thank you.
Thank you so much, Claire. So I could just wrap it up by just giving one sentence that pulls from each of their presentations. So essentially, in a nutshell, oversight is an active thing, and it must be demonstrated with what you do during the year, and it must also be seen within the public sector as well. So I think those were some key points that came out through our three panelists, and I want to thank all of you. I want to thank the panelists. They were distinguished, very knowledgeable. Their wisdom certainly came through, and we thank you for the jewels that you left with us today. We also want to thank the participants for being here, the questions that were asked, and just being here with us this afternoon. And so I now want to officially hand back over to Faye and Kamla.